questions that a mortgage advisor gets asked every single day. And we are joined by Cam Hastie from Hastie Mortgages. Welcome, Campbell.
Hello. Nice to be here. Thank you for having me once again.
You are such a knowledgeable man and such a laid-back, carefree mortgage advisor. We were going to talk on a different topic, but we're not going to mention that one. But I think it's a topic that people would want to talk about, and I think given given your heritage and your background, and your financial position now as a both an investor and an owner of many properties. I think you'll be in a really great position to talk about that. But we're not going to talk about that today. We're talking about the top 5 questions for a mortgage advisor. Those top 5, we're going to reveal what those are in just a moment. If you have a question for Campbell on either of these questions that we're going to reveal, then please use the comment section on whichever social media platform that you're on, and we will endeavor to, or Campbell will endeavor to, get back to you. Please use that comment section. Those top 5 questions are: how much can I borrow? How much deposit do I need? Do the LVRs impact what I can do? Is now a good time to buy? And which interest rate should I choose? And I'm interested in the last one because our fixed 2-year is coming up for I think in about 3 months' time. And
should we start with that one?
We can start with that one. Absolutely. Let's dive in. Which interest rate should I choose?
You started out by saying that this is a question. These are questions I get asked every single day, and they are. This one comes up probably 2 or 3 times a day, actually, as we're going through and talking to people about their fixed interest rate expiry that's coming up, just as yours is in a month or 3. Sometimes customers have seen on their Instagram feed or their Facebook feed, they've seen ads from other brokers offering this kind of refix advice and service. And some of those ads are all about or trying to reach for this nirvana, which is a situation where you smash your mortgage in about 3 seconds and you become mortgage free and you can live forever, happy days, maybe get a rental property and all that sort of stuff. And they talk about there being some kind of secret to paying off your mortgage quickly. And I want to tell everybody today that there really isn't a secret to paying off your mortgage quickly. Or if there is, it looks like this: pay more, do it more often, and if you can, do both. That's it. The only way to get rid of your mortgage quickly is to pay more often, and do both if you possibly can. And to a certain extent, given that that's what you should be doing if you possibly can, to a certain extent, the interest rate you choose almost doesn't matter. So the question, which interest rate should I choose? You can get all technical about it, but in a sense, it almost doesn't matter. The key thing that I think, the key test that's got to pass is the sleep test. Like, if you're scared about interest rates going up and up and up, and that keeps you awake at night, we'll lock in for a longer period, 4 years maybe. A shorter period of time probably isn't going to suit you, right? So we try and figure out the psychology of the person as much as we do the actual numbers and the financials, because you've got to be comfortable with what you've got. And that goes back to what we were saying before about paying more and paying more often. You've got to be comfortable about doing that. When people ask me that question, which interest rate should I choose, I also often introduce the concept of splitting their loan into a couple of bits, equal chunks normally, and we have an interest rate, say, fixed for 1 year on this chunk and fixed for 2 years on this other chunk. And that spreads your risk. It means your interest rate isn't all expiring all at once. And so in an environment where rates are going up, you've got an opportunity to adjust. In fact, there's a year between those 2 chunks expiring. So you've got a year to adjust, and you're not going to get smacked all at once when the interest rate change does happen. It's hedging your bets. You'll probably never pay the lowest interest rate going, but you shouldn't pay the highest either. You'll sort of cut an average through this. And that'll be how it is for, look, sorry, let me rephrase. If you can pay an average interest rate for 20 odd years, you're going to be doing a lot better than trying to pick the bottom and miss the top. And so that's the kind of conversation I have with people when they ask me that question. And again, the answer, which interest rate should I choose? It doesn't matter in a sense. What matters is how you pay it and how you structure it. Yeah? How's that?
I think that's a good answer. I'm still a bit confused for my investment property, which one I should choose. But yeah, just come and see you, right?
Basically, yeah.
All right.
Of course. I mean, I would love to actually talk through yours right here, right now, but we don't want to air your laundry in public. There's no need to do that. But essentially, I'll take you through some questions. Well, I'll ask you some questions that are all sleeping at night and therefore being comfortable with what you're doing and making sure what you're doing is going to fit your budget and keep you safe. That's really what I was trying to get to before. Okay? Simple as that.
All right. Next question, one of the top 5 questions that you get asked. Let's go back to the top of saying, which interest rate should I choose? How much can I borrow? How much can I borrow, Campbell?
Well, that really is a it depends question, which is not really an answer at all, right? But it really does depend. The basic formula is something that everyone will have a sense of. They'll go, okay, I get that. And it is income minus your expenses, minus whatever existing debt that you might currently have, should leave you with a surplus. And that surplus is the amount that can be used to pay a mortgage. So that basic formula is really what the bank's working through. And they've got a bunch of calculators. Each bank has got one. It's a little bit different, but they all work on the same principle in terms of determining how much you can borrow. The bank is going to stress test you, okay? A lot of people understand that the interest rate today might be, say, 5%, but the bank's probably going to stress test your ability to pay the mortgage based on, I don't know, close to 8%. You'll never pay that, but that's the stress testing they do. And they put that together into a calculation and see what comes out. And if the affordability passes, then that's how they work out how much you can borrow. The triple CFA is a bit of legislation that a lot of people have heard about these days. And that's all about responsible lending and doing the right thing by people. The interpretation of how that act works when looking at someone's borrowing capacity means that, boy, oh boy, the banks look bloody hard at things, right? They look really hard at your income. They pull it apart. They look hard at your expenses and they really rip those apart too, and they probably add a bit more in than you might like. When we're going through and doing that assessment, because we really drill down, we have to. The triple CFA legislation demands it. Man, we drill down into your bank statements and we will literally line by line 6 months of transactions on every single account you have. This is the level of detail that's required to find out how much it is you can borrow. You're going to find it really bloody hard to do it yourself. Just this whole process of applying what you think works probably doesn't marry up with how the bank views it. And so what I would say to everyone out there is that to try to figure out what you can borrow, the answer to that question, it's not as simple as using a calculator on a website, even the one on my website. You've got to really drill down into it. So it's always about a conversation with someone like me. We frame things up initially, and then if that kind of looks good, then we do the drill down and find out where you actually sit. And at that point, you can go, well, that works for me, or it doesn't. The drill down enables us to find out what things could be tweaked or improved or shaved or maybe expanded in order to improve that number, to make that affordability number bigger. The drill down is actually really useful. It's painful, but it's useful. But in essence, when we come back to it, it's the function is A minus B minus C equals a loan. That's it in a nutshell. Yeah.
And it's and given what I was telling you about before we went live was being clear about if you've got any extra income, to actually declare that, right, as part of that application process, even if it's kind of a sort of a one-off kind of little job that you might get occasionally.
100%. Yeah. Look, the bank is always looking for, from an income perspective, looking for regular income, consistent income. So one-offs don't have the same kind of weight. But actually, one-offs, they might not, you say one-off, but if they occur on a 2 or 3 monthly basis, and you look over a long enough period, they're not one-offs. They're actually regular in the context of a 2-year period. And so we can factor that in, right? Yeah.
Excellent.
So this is the kind of drill down sort of stuff that we do. That's a great example of it, actually. Yeah.
Question number 3 of the top 5 questions that you get asked every single day. How much deposit do I need?
Often this is the first question that people have. How much deposit do I need to buy that house, Cam? And following really closely after that, they might say, I've heard I only need 5% deposit. So let me tell you about the 5% deposit thing. There's a very narrow window where that's possible. And a 5% deposit currently is something that is available via Kāinga Ora's first home loan scheme, right? It is subject to income caps, okay? Subject to income caps. So what is that cap? Well, if you're a single borrower, 95,000 worth of annual income is the cap. If you earn over that, you're not eligible for this particular facility. As a couple, it's 150 grand worth of combined income. And again, if you earn over that, you're not eligible for that kind of facility. Now, the average price in Auckland for a first home buyer, in my mind, is about 800 grand. So if you've got a 5% deposit, it means you're of that purchase price. It means you're looking for a loan of 760. And I can tell you, if you're a couple earning 150 grand, you're going to be pushing the proverbial uphill to qualify for a loan of that size, right? We know the average price in Auckland is actually $1 million. So you're really pushing it uphill. The long story short is that a first home loan in Auckland provided by Kāinga Ora basically doesn't work. So I always say to people, if you heard of 5%, put that out of your mind. 10 is where you need to be. The next question really is, what are the things that I can use to make up that deposit? And there's a whole lot of stuff. Your regular savings, okay, that you might have built up, of course. Your KiwiSaver, for most first-time buyers, that's a big part of it. It's perfectly acceptable for mum and dad to write out a check if you've got parents who are in that sort of in that category and able to help. Awesome. Those are basically the 3 things that you need to bring together. And obviously, if there's 2 of you, you double all of that up. But yeah, in terms of percentages, it's got to be 10% in Auckland. The 5% thing might work somewhere else.
Maybe in East Cape somewhere in your old neck of the woods.
Maybe. Maybe, yeah. Seriously though, outside of the main centres, the first home loan probably works quite well for first home buyers who are in an above average income situation. It probably works pretty well out there. And I suspect my colleagues in Napier, Hastings, for example, probably do a lot of them. But here in Auckland, the price is such that it just doesn't work. So 10%'s got to be where you're at. If you've got 20, so much the better.
Okay, 20%. But if you've got more, it's better. Do the question number 4, do the LVRs impact what I can do?
100% they do, yeah. Let's just flesh out what the LVRs are first. So the Reserve Bank have re-implemented some limitations on what lending to people with less than 20% deposit, right? So LVR restrictions relate to people looking to borrow with less than 20% deposit for an owner-occupied home. And what they've basically done is they've said to the banks, the pot of money that you have available is very much restricted. There's only so much of it that you've got. So there's several impacts that has, or several implications that has. And the first is that because there's a limited pot of money, the banks are only assisting their existing customers. So if you're with ANZ and you're an under 20% person, you can't go to Westpac or ASB because those other two, they won't assist. Because they've got that limited pot of money, they'll only want to assist their own. Okay, that's the number one thing. So a possible workaround for that might be the right word, is if you're a couple, one of you should bank at Bank A and the other one should bank at Bank B. So you've got your eggs in two different baskets, and that gives you a couple of options there. I'd recommend that. The other implication, again, comes out because of that limitation in terms of the pot of money that's available, right? And the banks make you know, that stress test we were talking about before, the threshold is set at a really high level if you have less than 20% deposit and you want to buy an existing property. The threshold is set at a really, really high level. So it means only those borrowers with the biggest income are effectively able to get an existing home with 20% less than 20% deposit. The Reserve Bank don't have the same restrictions when it comes to a brand spanking new property. The threshold is not as high for that. So often what happens is I start talking to people about the difference between existing and new property, and we end up going down the new path. And that's a deliberate strategy on the government's part. They want to increase the housing stock here in New Zealand. So they want to encourage people to go toward buying a brand new place because that adds to the housing stock. And so the threshold for lending in that category is much lower, much easier to get. And this is why we've got a construction boom going on at the moment. It's one of the big implications. Long story short, we talk people through the differences there in that threshold and help them understand what that looks like and then which way they'd be more comfortable going. I had a guy I was talking to yesterday, actually, and he said, I quite like the idea of an existing house, and even though it's harder to get, that's the one I want. I don't want to go down this new path. They're all small and pokey. That's what he was saying. In his particular area, he's dead right. They are. And he's a guy with a family, 3 kids basically. So he needs a bit of space. And a brand new house, a terrace home ain't going to work for that fella.
Yeah.
So those, in a nutshell, those are the impacts of the LVRs when it comes to particularly first home buyers. 1, they've got to go with their existing bank. 2, the threshold for brand new versus existing property, that's something to really factor in as well. And you just act accordingly. We've got to, going back to that first question, which is how much can I borrow? And the second question, actually, the deposit and the LVR impact, all of those things actually come together into one when I'm providing some guidance to people as to what they can and can't do, because everyone's situation's a little bit different. They're all different income, different deposit, and different desire in terms of a brand new place or an existing place. So it can get pretty complicated, actually. But we get there in the end, and I think with those really big factors or variables, the calculation that's required and the psychology that is going on behind the scenes, you've got to have an advisor on your side to help you navigate through it. You really do. Far out, man. Yeah.
Last question. I'm just noting how comfortable you've become at doing these live stream interviews, Campbell. You're just taking your time. It's just this is there's so much to cover. The last question for you. Is now a good time to buy? You talk to your real estate agent friends on this one?
Well, they will all say now is a great time to buy. Actually, they will all say now is a great time to list. That's what my real estate friends will say. Put your house on the market. Is now a good time to buy? Well, let me rephrase that, actually. When is the best time to buy a house? When was the best time to buy a house? The answer is yesterday. And I mean yesterday in figurative terms. Because if you could have bought a house last year or the year before that or 10 years ago, it would have been cheaper than what it is now. And you would have built up a hell of a lot of equity over that period. And you'll be a hell of a lot better off financially. But yesterday is gone. The future isn't guaranteed. So the best time to buy a house actually is now. If you're capable, if you're keen, then you should do it now. And people will be chuckling about that answer and oh yeah, that's a bit of spin on it. But actually it's for real. Because yesterday has gone and the future ain't guaranteed. And if you want one and you're capable of doing it, why would you muck around? Get on with it. The bloody things always go up in value, right? That's what we've seen. Even through the last, 50 years, we've had various financial crises and oil crises and, the tech boom and bust and all that sort of stuff. Good old properties just sort of chugged along and it's ended up increasing in value over the long term. Will that continue? I don't know. For the last 50 years, says probably.
Yeah. Well, I remember 1971, my parents bought a 4-bedroom house in Castor Bay and they paid $28,000.
Oh, God.
Castor Bay, they sold it in about the year 2000 for like 1.4.
Yeah.
And then now it's worth 3.4. Buy a house. So you're saying buy a house today. If you've got the means, have a conversation with this good-looking man in yellow today. Or go to hastiemortgages.co.nz. You said you do have an online calculator. You said that you still want to have a conversation with Campbell, but see how much you can borrow at hastiemortgages.co.nz. Thank you, sir, for a nice wee chat, and we shall see you next time.